I am kind of like an idiot savant. I'm a stock market savant. I am the portfolio manager is me, George Patton. I'm a stock market savant. I've had 30 years in the business since 1981, both privately and publicly, trading stocks, recommending mutual funds, writing newsletters. And we're now in another growth opportunity where we're looking to expand into the hedge fund arena and bring our expertise to a new, wider audience.
Excellent. All right, hey, check it out. If you're just tuning in, it's Robert Taylor, co-owner of InformationInvestor.com. That is InformationInvestor.com. I'm here on the air with George Patton, longtime analyst, Wall Street veteran, portfolio manager. He is the stock market savant. This guy has cold as ice intel. Business, market, stock, intel, and he's right here on the air. Kick some flavor, George.
Hi, how you doing, everybody? Robert, I'm glad you started out with Intel because it is all about information. Information Investor is a great name. It's all about Intel. You need to be out in front on the Intel, and that's how you make the money and stay ahead of the crowd. We use not only the fundamental Intel, staying on the cutting edge, looking for these companies with the differential advantage that are going to keep them ahead of the competition. We use technical analysis, of which I am a 25-year veteran of. And using the technical analysis, we look for the little clues that are going to give you the big profits, are going to show you the market direction before the average person realizes what's going on. Again, as we were talking about May 25th, I realized we had a pattern that we had not seen since Bernanke began the QE2 program back in September of 2010, which indicated to me what we had all thought, that, well, once QE2 kind of runs out, the markets are going to revert back to the previous pattern where they had been going down. August of 2010 was the worst August in 40 years since 1961. That's when Bernanke got scared enough to realize that, well, he's going to have to try and pump some more money into the economy, save the market from crashing once again, because that was the only thing holding up the general economy and consumer confidence. And the markets responded accordingly, coming back from a low of 96.14 to a high of 12,800. But as soon as that money started to run out, or it became evident that by the end of July, end of June, another month later, the funds they would stop buying long-term bonds, the market started to revert. The early sellers, the big money, started taking positions off the table as they usually do. Ralph Ancampora, a famous technical analyst, told us many years ago in school, said, hey, the big money puts on positions very slowly and they take them off with even greater care. That's why you look at the technical analysis signatures of big money selling, and then that gives you the clue as to what the pattern is going to be. But as I was saying just previous to our break, who knew that in July, when I called for Mr. Toad's wild ride, that we were going to get 18% down in about 20 trading sessions. But we got it, we're there, and what it means to me now is we have a harbinger of even more profits to come. Unfortunately, it's going to be on the short side, but you've got to be early and into this to get the big profits. You know, they say it's the early bird that catches the worm. What we do is we try and look for the anomalous situation. We try and look for those bargains or differential advantage that give you an edge in investing. You don't want to have to trade all the time. You don't want to take algorithms and trade 5 or 10 times because, you know, you're taking up a lot of time and the propensity for errors tends to creep in. We want to look in good markets. So, example, we look for companies with a differential advantage, with a unique selling opportunity. Green Mountain Coffee was one when they came out with the Keurig single-serving cups. That market exploded because the marketplace was ready for that, for a great cup of coffee every time without the waste and the mess. We like Netflix. We found Netflix at $50 a share and ran it up to $120 before deciding that, well, you know, there were probably better opportunities somewhere else. We took a look at Baidu and figured that we had 325 million internet users in China. We had a limited competition due to the closed nature of the system, and that this stock and company were firing on all cylinders. They had the approval of the Chinese government, the general political party backing them, and it was a win-win situation. Well, Baidu, as you probably know, is up over 10 times since the market bottom in 2009. We look at all these huge situations, like never betting against William Shatner of Star Trek fame, you know, Captain Kirk. Priceline.com is a huge winner and continues to outsell and outmarket the competition at every turn, quarter after quarter. So these are the type of things we look for in an upmarket. We also use technical analysis to look for major turning points in the marketplace, and that's what we feel that we have now. Now, if you go to bostonwealth.net, you look up my May 25th commentary called 5 Waves Down. We looked at that. I looked at that pattern, and it indicated to me that there was a change coming in the marketplace. Now, extrapolating out, I timed it almost perfectly, which is actually unusual for any analyst because there are always a little bit of variances in the pattern. But when I called does look like the world once again is slowing, and most of the major economies are going to go into recession or, at the very least, slow growth.
This is what if you're just tuning in, check this out. George Patton is the man, okay? If you think there's anybody else out here in this world of ours who's on television, radio, giving stock analysis, this guy, if you don't know about George, what is the website that people can visit online that you administer?
BostonWealth.net is the site that I'm privileged to blog on. And I say privileged because all of the gentlemen on that site are extremely experienced, have years in technical and fundamental analysis, and every one of them saw this decline coming weeks, if not 1 to 2 months in advance of it happening. So if you listen to a lot of the talking heads out here saying, oh, well, the market is fairly valued at this point, or the market is a good buy at this point, or hold on to your stocks, Wall Street never tells you to sell. I mean, between my mom and I, we had over 60 years of experience on Wall Street, and brokers are taught never to tell your clients to sell, because selling doesn't make money for the company. In the old days, when you sold a stock, the company acting as intermediary would be buying the stock back, so they're holding it in inventory. Obviously, they don't want a declining portfolio in their inventory. It's bad for business, so it's better to have the clients lose money than it is for the firm. There's a great book out, just had a reference to it recently. It says, where are the customers' yachts? Yeah, the brokers have the yachts, but where are the customers' yachts? You want to see the broker that has customers that are happy and making a lot of money, because that's what it's all about. And that's what I like to do. I like to make money for people. I like to show people how to make money. And even more importantly, I like to show people how to save money.
And if you're if you're tuning in to George Patton, stock market savant, he says, and this is true because I bear witness, this man is very similar to that of an idiot savant. He's not an idiot by any measure, but he is ingenious. He has stock market intelligence that you will not hear anywhere else. This man has amazed me. I am amazed because he has predicted some cold future outcomes for America and the world, and they are precisely correct and accurate 100%. George, give the audience some of your past predictions. Please elaborate in terms of what you have predicted in the past that I am aware of, that others know about. Let the people know what is going on, what you are certain is going to happen in terms of the economy.
Well, let's go back a ways. And yeah, I love the game. I have a passion for it, and I have an acuity for technical analysis because I can look at chart patterns and I can make extrapolations. Now, some of my earliest clients were claiming that I called the crash in 1987. I did not call that crash, but I knew who to read. The people with the best track record, the people with the best economic sense, and I followed their advice. And when I followed their advice and gave it to my clients said, oh, well, you're fantastic. You did this. I said, no, I didn't do that. I just followed along. But as you develop, you see what they're doing, and you can replicate that, and you learn and build upon that. So, yeah, we looked at several different things, from crash in the Nikkei in 1990 to the long-term crisis in 1997-98. So many different things. I mean, I can go back to the market in 2006 and 2007 when I wrote the book Blackjack, A Drama of Magic, and used the chapter 1929 comparing the current day to back then. Who knew we were going to get the crash pattern in October of 2008? That was the exact same replication of the 1929 crash without that fateful final day. I actually estimate that the Dow probably would have dropped about 2,000 points on that Monday in 2008 had not governments around the world rushed in funds to shore up the market, which does on a good note show that we can learn as a society. But then still, again, there's sometimes where people are very hard-headed, like Trichet at the European Central Bank today. They're raising rates just as they did in 2007, oblivious to the crisis that's unfolding around them, and putting us perilously close to having a repeat performance, and that's what we're here to talk today about, the possibility of a global synchronized recession once again within 3 years of the last occurrence.
Now, George, before we reveal too much, give the audience a brief rundown of your background, where you come from, how you came to be in the business of managing portfolios as a manager on Wall Street. Who are you, brother? Let the world know who you are.
Well, let's start when I was 11 years old. And Robert, you don't know this, but I think you do know my mother was a broker. She worked at several different brokerage firms over her 30-year career.
Morgan and Stanley?
Finally, as the vice president of Morgan Stanley. Now, when I was 11 years old, I started helping her collate her trades, because back then all the trades, the tickets were made on paper, and the weekends she would have to collate all of her clients' trades. And so I became interested in stocks, and I picked a company called Microdot, $10 of the greatest investors of all time. He was one who called the crash in 1929 a year before it happened and wound up working on, I believe it was Hoover's committee afterwards to try and create solutions that would prevent this from happening again. But Bernard Baruch has a famous quote: if you spend all of your time investigating and learning and researching companies and stocks and patterns, hey, you might make a living.
George, that is freaking amazing, man. Listen, anybody out there in the world who is interested in having George Patton come on your TV show, your talk show, your radio show, your webcast, anybody who wants George Patton at your college, your university, institution of higher learning, your corporation, any board meeting, if you want this kind of analysis, listen, I am a business intelligence analyst myself, and working with George is amazing because you see so much crap in the news, online, offline, in print, and man, George, kick some knowledge and let people know what you know that no one else knows.
Well, Robert, thanks. One of the things I wanted to talk about just briefly is my Coast to Coast AM appearance on May 15th of this year, which is available on YouTube.
That's right, congratulations.
Where I talked about the price of gold, and my new target for gold was $21.50 by the year 2013. And I was telling that to somebody this week, and they said, well, that's nothing. It's only $300 away. Well, in May, it was a $600 away point, and at the time we were kind of expecting a correction for gold to go back down into the $1,300 area before possibly by the end of the year renewing on the upside. But what has happened most recently is there is a panic in the currency markets, in the stock markets. People are running out of currencies, the weaker ones, the euro, the dollar. They're running out of all stocks around the world. I'm watching all of the international bourses turn down at the same time, and they're running into the safest places they can find, which are the Swiss franc and gold. That's why gold is up in the same period of time where the Dow is down 18%. In 3 weeks trading sessions, gold is up over $200. I mean, it's just been a fantastic run. It shows that there's panic out there, and there may be some blood in the water. Sharks are swimming, and we may see a hedge fund or two go belly up, which will just create a further panic, which is why I'm here to warn people that, even if you don't want my advice, even if you don't want our help through informationinvestor.com, you need to protect yourself. You need to do a little bit investigation now and see where you can pare back your portfolios. And one area to look at always as a leading indicator are banks and brokerages, especially this time around, since at the height in 2008, banks held 41% share of the S&P 500. That's a huge overbalance of where it should have been, and shows you how inflated the financial sector was through the mortgage packaging, CDOs, CMOs, and the whole housing and finance industry. Was just hugely overvalued. It was a bubble waiting to be popped, and when it popped, it's come down to the point where once reinflated, it went sideways for a period of time through QE1 and QE2, but it's now turning down again, and it's turning down in spades kind of because all of the individual debt that was packaged through the banks and sold to investors was then bailed out by governments. Well, this debt is still there, and this debt is still horrible. It's, as you would say, crap, or, it's very ugly, untradeable, frozen market type stuff, but it's now owned by the governments. And guess what? The traders have smelled out the governments, and they say, hey, listen, your bonds are going down, your countries are going into bankruptcy, and we're going to get out of your currencies, and we're having a flight of quality to the highest, safest things, and there are a few things safer than gold, but even gold isn't big enough to hold the stampede out of all other types of investments that's coming. That's why we may just see things here that I can't even predict.
Wow.